Treasury yields made a big move lower today. Actually, they've been making that move lower. It just seemed like it was exaggeratedly low today on a day when it wasn't about a big economic day. There wasn't any event around the world. There was just continuation of what we've already known. Yes, there are stock earnings coming out and stocks are doing fine. Yes, there are still issues going on overseas between the UK and the European Union, but certainly the move that we've seen seems to be something else underneath the surface. A greater demand for treasuries, maybe a bid here coming on based on a flight to quality, maybe based on a short covering. Given the fact that the CFTC has not been able to release the positionings report and neither has the TFF, we haven't been able to see where those leverage funds have been doing with all those shorts they were holding on to as of December 18th. So my sense is that some of this is coming from a have to buy standpoint, not a want to, and we're starting to see it pick up some steam and gain a lot of momentum. So the big move now, we closed today right around 262 in 10-year Treasury note yield, certainly well below that 275 line in the sand that we were dancing around not too long ago. And I think the next stop, this is going to sound a little bit out of left field, but the next stop could be 230. That's going to be below the year-to-date low. And if this buying continues, if this demand continues, yields could start to really move and pick up more and more momentum as they get lower, at least until you get to a point where you start to have sellers come in. But we aren't there yet, and we may have a gap that we need to fill, which would get us to 230, not today, not tomorrow. But I think as this trend continues, we could see it in the coming weeks and months. And if you look at implied volatility, while it hasn't gone down this week, it hasn't gone up very much either. And I think that is an eerily quietness about volatility here that suggests that the market is unsure of whether or not we're going to go back into the old range or continue on the current move, lower in yields. And my sense is that things are a bit cheap here, in volatility speak. Yes, I know things are great in earnings land, and equities look to be, extending their gains to the upside. But Treasury yields, heading lower as aggressively as they are, probably should come with a little bit of concern. And we're not seeing it priced into volatility. So volatility looks cheap here on this move. And lastly, the post-FOMC trade. Yes, it was a big move. We saw post-Powell and company yesterday. The keys here that we're going to see are going to be about the economy and growth. Can we sustain the growth or near growth that we saw in 2018? And then Mr. Powell said we probably could. Secondly, is going to be the Fed balance sheet. An issue that was touched on yesterday. The Fed may hold more treasuries and agencies than had originally expected, at least for a longer period of time, which obviously is very bullish to treasuries if they're not going to be flooding the market with more supply. And lastly, the hard Brexit, which I think they talked about it yesterday in the press conference. It is certainly going to be of concern to the Fed, but the ripple effects of how that will affect our financial system, while are negative, how negative can they be? And I think that's another question that we're asking. So right now, we've got more demand, we've got more buyers, we've got a lot of uncertainty, and Treasury yields now starting to pick up steam on the way down. Something I don't think many people expected. And if you throw into the kitty, the Fed fund expectations are now flipping from possibility of tightening 0, possibility of staying the same very high, but now possibility of easing in 2019 is on the rise. I don't think they're going to be easing in 2019, but the market right now is kind of leaning that way. It will be interesting to see what happens after we get through tomorrow's jobs report and we get the backlog of data that we've been missing since the shutdown. So right now, Treasury yields, momentum pushing to the downside. Don't think it's going to stop just because we get a good jobs report or just because something good happens. I think this momentum is here to stay. And when the positioning reports come out, that may be the key as to why we're seeing this move now and so fast.